adjustments based on your borrower's credit score and their down payment and what they're buying, versus, versus like what the normal rate would be. So this is Fannie Mae and Freddie Mac. This means that every lender that does a conventional loan is using this same grid. It's usually built into their pricing. If you ever read really small print on any advertisements, you'll see references to this, but let's summarize it. So you always get the question of like, where's rates at? And you can always tell somebody where the best market rate is. But if you look at this, and if you look where my mouse is, okay, this says is a borrower with greater than a 780 credit score and a buyer that has 25% down payment, okay? So your best rate is greater than a 780 credit score and a 25% down payment. Now, you know, and I know that these buyers are few and far between. So what will typically happen is you have buyers that have adjustments to that rate. So let's say that you have let's say the market rate today was 6%, okay? And let's say a buyer is putting down 20%, not 25. So Freddie Mac and Fannie Mae basically say, okay, we need to charge this buyer 0.375. So in the simplest terms, if it's a $100,000 loan, that's $375 more in fees. If it's a $200,000 loan, that's $750 more in fees. Normally, what will happen is that a buyer doesn't want to pay those fees. So instead of quoting a buyer at a 6% rate, you would say, okay, well, your rate's going to be 6.125. Okay. So a lender might quote on a 20% down, they'll say this is where the rate is today. But the buyer might not realize if they put down an extra 5%, they probably could have gotten a better rate or lower fees. Where this gets kind of crazy is when you start going down into like 760, 740, 720 credit scores. These have traditionally always been very good credit scores, okay? If you have a 720 credit score, you've been doing a really good job monitoring your credit. However, if you have a 720 credit score, and let's say you're going to put down, let's go across here, and say you're going to put down 15% on a down payment, you can see this has a 1.25% charge to the buyer. So it gets pretty expensive as your credit score gets a little bit lower and you have lower down payments. So what does this mean for you as a buyer's agent? If you ever have a buyer that says, hey, my lender says my rate's higher because I have because of my credit score, this is why. So these were not as harsh prior to May of 2023, but all these adjustments, all these numbers you see, like these did not exist in this same level. It was the buyers between like 680 and 740 credit scores that got hit the hardest last year, to the adjustments to their rates. So I get sometimes
Rocco, you're frozen.
telling me, hey, can we go conventional? How about now?
Okay. So it cut off when you said, I get sometimes, and then it froze.
So you get a buyer that's FHA pre-approved, and then I'll get a call saying, can this buyer go conventional? Sometimes the answer is yes. But if you have a $200,000 or $300,000 buyer that's FHA, and now they go to go conventional because they had say a 680 credit score, their payment might be $200, $300 higher per month just because they're going conventional. So it's not that an FHA buyer doesn't always qualify for a conventional loan. It could be that their cheapest payment is on FHA because FHA doesn't have these adjustments for their credit score, okay? So this top grid, if you're ever bored and you want to look at this, you can Google LLPA. It's the first thing that comes up, okay? The second box is property type. So you might hear someone tell you that, hey, investment properties have higher rates. They don't. But most buyers, if we go down to where it says investment property, most buyers putting down 20% don't want to pay 3.375 in points. So instead of having them pay that, you quote them a higher rate. So as you go up the rate scale, it counteracts the points that they have to pay. So investment properties, which have a lot of fees, to not pay those, you quote them a higher rate. So that's where this stems from. And again, this changed last year. If you have a listing and your buyer's a buyer puts in an offer on your property that's FHA, it's not because they're a less qualified buyer. It could be just because their pricing is 10 times less expensive. Even PMI, conventional loans have PMI, just like FHA loans do, but conventional loan PMI is also credit score based. So if you have that 690 credit score, your PMI is more expensive. So as buyer's agents, I want you to be aware why you might have a buyer that presents to you an FHA pre-approval. And then if you ask, can you go conventional? Sometimes the answer is yes, but it's a much more expensive for them on a monthly basis specifically because of this. That makes sense?
Yes. The question I have is, so you said FHA doesn't do this loan level price adjusting, right? So this is only conventional loans?
You will see that because it's all about risk. So Freddie Mac and Fannie Mae consider these buyers higher risk. So that's where they charge these fees. If you have a FHA buyer that's like in this below 620, which some lenders won't even do, you may have a small adjustment in those buyers, but nothing like this. Nothing like this. I just had a buyer that bought a $280,000 house. I pre-approved him FHA because he had a 690 credit score. The only way the seller would accept the offer was conventional. I told him like it's gonna be $300 more per month. And that was the only way he could get his offer accepted, according to the agents. So that's what he did. But was he less qualified? No. Did the house have any issues? No. It was a listing agent that was uneducated. They thought that an FHA buyer was less qualified, and the house had no peeling paint. The house had no handrail concerns, but they just wouldn't accept an FHA offer. So my buyer had to eat $300 more per month because of these pricing adjustments to go conventional.
I mean, I'm going to unmute everybody here. Does anybody else I don't know how to unmute everybody now. Uh-oh. So the question is this, everybody, I was always of the opinion that FHA loans are for those people who can't qualify for a conventional loan, right? Did anybody else think differently? That's kind of how I was taught. FHA loans, you have a lower down payment, they're more friendly to buyers who don't qualify as well, blah, blah, blah. But so conventional loans historically, seem to require a better down payment. Why punish conventional borrowers like this?
So I was actually interviewed by the news about this last year at some point when the changes went down. You can get political on it, so I'm going to try to play in the middle of the road. The government, Fannie Mae and Freddie Mac are ran by the government. They did make it less expensive for the 640 borrower to go conventional, but it's still expensive. It really penalized those people in the middle of the road. I don't know why. They make more money off of this. Don't forget, this is revenue directly into Freddie Mac and Fannie Mae's pockets.
Okay.
But
so the lender,
prior to May of 2023, that was pretty much the normal argument. And a lot of agents still believe this. But again, you have a lot of buyers that can go both ways. If you're in that 680 to 740 credit score range, it's very often where if you run both payments next to each other, FHA is going to be significantly cheaper. But when you have listing agents saying, I don't accept any FHA offers, then you flip it over to conventional.
Okay, so these loan level pricing adjustments are mandated by Fannie Mae, Freddie Mac.
Yep.
And they're on all conventional loans regardless of borrower.
Yep.
And now is it only because this is for conforming loans, right? So let's say if we talk to a credit union or someone who's going to hold the loan in-house, can they not do this, or are they still required by law to charge these additional charges?
So there's two. So let's talk about what they mean by hold in house. So we hold all of our servicing, which means your bill, if you do a mortgage with us, you get a bill from us. The actual asset is always sold off to Freddie or Fannie, even if you're a credit union, because credit unions can't hold, either can banks, they can't hold on to these large amount of liabilities that they're only getting back a tiny percentage every month of. So yes, any standard conventional loan, even if it's at a credit union, is going to abide by these. If it's like a non-warrantable condo, or but there are a few small circumstances, but I would say 85% of the mortgage loans are either FHA or conventional, no matter where you are.
What about VA, USDA?
Yep, VA is government, so government lending, specifically FHA, VA, USDA do not have these.
Okay, and then you said that there's additional points that are on top of what the bank is charging to borrow the money, right? And every bit of that additional money goes to the government.
It goes to Freddie Mac or Fannie Mae, yeah.
The government controlled entity, right?
Yeah. So yeah, a buyer may not see it, like they won't see that charge of 1.125%, but their rate might be slightly higher than where the market is. So if the rate's 6, that buyer ends up with a 6.3 rate. That's why. Instead of charging that buyer that fee, most buyers freak out when they see that, you just quote them a little bit higher.
I see.
Yeah.
That
if you Google
vomit.
LLPA, it's the first thing that comes up. There was legislation, I don't know if it's still in Congress right now, to change this back to the way it was prior to May of 2023. But this is a thing that every lender deals with. You can ask around.
I do remember hearing about this in 2023, and they were saying something to the fact that they were going to charge these things in order to help people who didn't qualify as well to get loans. Like that was what was going on.
It does benefit lower credit score borrowers. If you compare what it used to be to where it isn't today, borrowers, I think below 660 benefited. But the weird thing is, as you get lower on credit score, even if you make a ton of money, a lot of those borrowers just don't qualify for a conventional loan anyways. So again, why they made the decision, I don't know. It exists. It's a real thing. It's out there.
They made it to steal more money from us.
Yeah, that's part of it.
Man, interesting. Does anybody have any questions for Rocco?
I'm curious, is there a limit on the FHA loan amount? And also, is there a limit on the credit score? Like, why wouldn't everyone just do FHA loan? Like,
why wouldn't everyone do FHA? Well, first of all, FHA has PMI, no matter what your down payment is. So that's number one why everybody wouldn't do an FHA loan. FHA is a little more stickler with like property conditions, such as you peeling paint. Always look for peeling paint. Handrails, always look for handrails on steps going into basements, steps on the front porch, or steps on any decks in the back. Uneven concrete. You ever walk down a sidewalk and you get that like higher slab? If it's over 5/8 of an inch, FHA wants that leveled out. Loose wiring. There's a mentality in real estate which stems from stuff years ago that if you do an FHA loan, you're going to have problems with the appraisal, but if you do conventional loans, there won't be any issues. It's not the case anymore. Like you can't get a conventional loan if your roof's peeling, but a lot of buyers don't go FHA because the listing agents say no FHA offers. The listing agent sometimes says no FHA offers because they know that it has peeling paint or because it has step requirements and the seller's not willing to do anything. The other reason a buyer won't go FHA is, and besides the PMI, that's always there, never goes away, is it just has a connotation behind it. It's not, it's the perfect loan, especially for buyers in that 660 to 720, 740 range in terms of getting them the cheapest payments. But long-term, they can never remove the PMI. It's always on their loan. That's another downside to FHA lending.
Okay, so if you bought a $750,000 house and your credit score was 780, the only downside of getting the FHA would be the mortgage insurance.
Yeah, the FHA does have a lower loan limit. I haven't done a high FHA loan limit though, but FHA loan limits are like a little bit lower.
Okay.
You don't traditionally see buyers who are buying in the $700,000 range, or even like above 500,000 have, they usually have down payments. They usually have credit scores a little bit higher. They usually have typically, not always, but typically.
Okay.
And FHA loan limit's like 500,000.
Okay.
But I can't tell you how many times that I've actually had a buyer pre-approved FHA, was looking at a property they really liked. The seller said no FHA offers. Their offer was the strongest from what I understood. I said, go find out why. And then we found out why. And the buyer was like, it's not a big deal. And I told him it's not a big deal. And we closed the deal. But if we wouldn't have talked to the listing agent about why they weren't accepting FHA offers, that buyer would have never got that home. I actually think Molly did that once, a long time ago. But yeah, just be aware. It has negative connotations that are unfair.
Yeah, I've always said as much too, Rocco. I mean, just based upon the fact that an FHA loan typically has between 30 to 50, sometimes 60 basis points lower credit, or interest rate than a conventional loan, which can, depending upon the size of your mortgage, can have a significant impact on your monthly down payment. But then I didn't even know that there's additional fees on top of, like you're saying, you get somebody who is looking at a 6.3% interest rate online, but it's actually going to be 6.425, and it's because of this. So that makes that disparity between FHA interest rates and conventional even greater than it appeared on Mortgage News Daily, right?
Yeah. Yeah. And if you watch Mortgage News Daily, you'll see sometimes FHAs just in general are always a little bit cheaper.
Yes.
Recently, that's been the case. So not only have they been cheaper, if your credit score is a little bit lower, they're even more cheaper. Just if you're a listing agent and you have a buyer present an FHA offer and it's the strongest price and your seller's going to make the most money, you really got to think about, are they a bad buyer? No, they're not a bad buyer. I mean, some of them are. I mean, FHA, okay, this is why. FHA will do the 580 credit score borrower. They will do the 620 borrower. Conventional typically won't. So because of that, as soon as it's an agent who thinks FHA buyer, they think low credit score, maybe has income issues. That's not always the case.
Mm-hmm. I got a question, Rocco. What are your thoughts on why? I mean, this stuff is incentivized to have people use these federal programs. What is the government's? Why do they want to take on these liabilities? What do you think about that? That's a tough question, but why do you think the government would incentivize people to go through their products and their vehicles and take on more and more liability? I mean, they already do an incredible amount with Fannie Mae and Freddie Mac, right? I mean, those are mortgage lending institutions that are owned by the United States government, and they're buying up all the mortgages in the secondary marketplace, and they're just really trying to shovel consumers into those federal products. Why do you think?
Traditionally, mortgages have always been a very safe investment for investors until 2008. So people, if you look at your own bills, you have a house and you have a credit card and you have a car payment. The one thing that you're always typically going to make your payment on is your mortgage. So if you go back, let's say that I'm a bank or I'm the government and I'm going to insure this mortgage loan and you're going to say, well, I'm going to give you $1 million and you're going to pay me back $4,000 a month. I'm really never going to see that asset. So that's why banks sell these assets off, and they're usually safe investments for investors to invest into until the mortgage crisis of 2008. But even since then, most people will always make their mortgages payments on time. So a mortgage-backed security is a very safe investment. And so the government's got the sort of money to back those and insure those loans as long as that 2008 never happens again. That's why they're safe, secure, investments. Typically, people will always normally make their payments, or they'll do everything they can to keep in their house. Have you ever watched The Big Short?
No, I read it.
Yeah. So that's kind of the thing. That was the one time that they were like, the economy got so out of control was because they're like, hey, we'll just lend to everybody because people will always make their mortgage payments. Well, eventually, not everybody's always going to make their mortgage payments, and some people stop making payments, and then the values all fell apart. But normal loans above a certain credit score, whatever algorithms they figured out, people will typically always make their payments or figure out a way.
Got it. So they incentivized the wild ass lending in the early 2000s. It happened. And then we had a giant crisis, and Fannie and Freddie then just took over the mortgage lending industry completely.
Yeah. So it's also to keep liabilities off banks' books. So you can't have billions of dollars waiting for people to pay you back a tiny amount comparatively every month. So you always sell those assets off as a mortgage-backed security.
That's interesting. Okay, does anybody else have questions for Rocco? No? Hey man, I appreciate you coming on, Rocco. If you want to take off. The rest of us, I just wanted to talk for a few minutes more. But if you don't have any questions for Rocco, hey man, I appreciate you coming on today and talking to us about this stuff.
Yeah,
I've heard about it before, but I understood none of it, to be perfectly honest. And this put it in better perspective.
Yeah. So if you ever have questions about this stuff, because it's a lot, don't hesitate to reach out.
Very cool.
All right, bye guys.
Thanks, man.
Thanks, Rocco.
I do remember this. I think Jay talked to us about this, right? Did he present to us when he was still at Your Home Financial?
Yes.
Yes, but I didn't. I remember him talking about it and simply talking about how costs would go up, and the fact that it was intended to help less qualified buyers. But I didn't understand it like I did now. That was interesting. Does anybody have anything they want to talk about before I have my little piece? No? Got listings coming up?
I got a new one. Sell it.
All right. So the only thing I wanted to say was, you guys, it's been a good year. We are, where is it here? $16,153,140 in production on the books. Up into, what is this here? This is the last month of the third quarter. So we got almost 4 whole months to go. That's pretty awesome. And so, it's been a long year doing business. The people you've done business with, have you been plugging them into KB Core? Yeah? Cool. You got them on a follow-up plan, because those people are going to be the ones that send you your buyers next year and the year after and the year after that, right? So making sure you got a system in place to constantly be reaching out to them. When I say constantly, I mean like maybe 4 times a year in different media. Are you Facebook friends with all of them? Probably. So they'll see your stuff there. But in some other way, keep in touch with them and ask them. I mean, there's no shame in calling them once a year and asking them if they know people who need to buy or sell, and if they know a business that you might be able to win. It's wild, but people will know people, and they won't tell you because they're just not thinking in those terms. But if you ask them, well, you know what? My uncle was talking about doing it. It's wild, but it's true. It works that way. I remember when I was selling playgrounds, and I would go into elementary school offices, and I would hand the catalog to the secretary and say, hey, this is for a PTO. And she'd go, oh, thank you, and turn around and walk away. And then I go, do you know of anybody in the district that's been talking about doing a playground project? Actually, the PTO over at this school, right? And she wouldn't have told me that if I didn't ask. And you'll have people you might call and talk to often. And if you don't ask them, if they know of other people who might be looking to buy or sell, they might not tell you just because they're not thinking about it in the course of that conversation. So asking for business is big. That's all I got for today, guys. All
That's
right.
it?
Hey,
That's all you got?
yep, that's it. Have
That's it?
and that's it. Have an awesome Wednesday. Lisa, Molly, you and I are going to talk right after this, but everybody else, thanks, man. Thanks for coming and listening to Rocco.
Sorry, I
That
couldn't
stuff
be here in
was
time.
interesting to me. Yeah, you made about 5 minutes, Barb. 10.
I told her we had to move on with the PT, but whatever.
This is I did record this one. I'm going to stick it on YouTube and share it with everybody, pending Rocco being okay with that. I forgot to talk to him about it, so I'm going to ask him if he's okay, and then if it is, it'll be there. So, all right, guys.
All right. See ya.
Have a great day.
Okay,
Bye.
bye. Thanks.
Molly, where'd Jonathan go? Molly, we lost Jonathan. Hello? Molly, can you hear me? Unmute.
Can you guys hear me?
I can.
I can't hear you. Hold on. You guys there?
I'm here, but I don't know where Jonathan went.
I don't know. He said he switched it over.
Switch to where?
He said,
I saw that, but I don't know where he is.
I just moved the. Oh, it probably has a new link.
Oh,
Yeah, it has a new link. It's in your email right now. Oh.